Before we get started, I want to talk about this webinar series for a second. Once upon a time, it was the beginning of COVID, and David Fryman and I were talking about what we could do to drum up business and make things happen. And we had this idea that we should do a webinar, get people on. And I don't know, probably David's idea, but whoever's idea it was, we did a webinar together. I think we had 3 or 4 people there. Um, and I was a little nervous before it started. I said, what if we run out of time and Zoom cuts us off at 45
Yeah.
minutes? It'd be a shame to lose everything. So I said, okay, Imperial, we'll get the Zoom. And that's when we got Zoom. And I haven't counted, but it's been, at least 3 years since then. So we've probably done, I don't know, 40 or 50 webinars since then. And it's really a pleasure to be back here again with David Fryman.
Yeah, it's like getting the
Um,
band back together, reunion.
so yeah, I mean, we talk besides for our webinars, but it's
Yeah.
really good to have you here. All right, so welcome everyone. Thank you all for joining us. We're going to talk today about buy-side due diligence, scams, some interesting things that we've seen. I'm going to start by introducing Imperial, and then I'm going to let David introduce himself. Then we'll talk a little bit about what is a scam, what you should be looking at when you're looking at a deal, some things we've seen, legal issues, go through a specific deal that we worked on together. And then at the end, we'll have a little survey where we ask you for feedback, take a minute to tell you about an interesting deal forwarding service that we started recently. And yeah, so that's kind of the highlight, or the high level rather. All right, and then we'll stop for questions periodically, and if not, we'll definitely take it at the end. If you have questions, jump in, let us know. Okay, so I'm Gershon Margolis. I'm the founder of Imperial Advisory. We are a fractional CFO and corporate finance consulting firm. So as the CFO, we pick up where accounting leaves off and typically work for CEOs, business owners, and we help them make better, more informed business decisions, help give them the insight, the knowledge, not into business in general, but digging deep into their business and helping them get what they need so that they can do what they're really best at. And usually that's not corporate finance. It's usually not what they're best at or what they want to be doing. So anyway, we kind of free them up to do what they want to do. We also sometimes work with CFOs, and sometimes there's bandwidth issues, certain specific skills that they don't have, and then we get hired by CFOs. I want to acknowledge several people from our team who are here. I don't know what all their names are, but it says Imperial CFO. If I see faces, hey Steve, welcome Steve, one of our amazing CFOs. My partner Ken, whose face is showing. Thank you for joining us as well, and whoever else is here, thank you, and of course thank you to David and to all our guests. There was one other introductory point before I turn it over to David. Slipping my mind. So
I mean, just to clarify, we are anti-scam. We're not
yes,
neutral on the topic. I was like, well, talk about scams. You might want to avoid it. You generally want to avoid scams. That's a kind of one of those intrinsically bad things.
yes, and hopefully today we'll give you some insight into due diligence in general and to scams in particular. The one thing I wanted to mention that I remember, and I'll turn it over to David, is that for any of you who do or don't know me, my goal in life is always to not be the smartest guy in the room. And besides for welcoming our team in general, our team is what makes us, and they're amazing. I just did a survey this week with the team. We have over 100 deals under our collective belt, mixture of buy side and sell side. Many of those deals people on our team ran at their organizations. Sometimes they didn't run them, but were part of them. And they range from, $100 million deals to 500 or maybe even $1 billion. So, and some of those deals were a while ago. So $500 million 20 years ago is probably like $1 billion today. So anyway, we have a lot of amazing experience. I've touched some of what I'll be talking about today, but you may hear from people on our team who are all welcome to jump in. Ken, my partner, did a lot of the work on these deals that I'll be talking about today. And if he wants, he's welcome to jump in. Without further ado, David, take it away.
Thank you, Gershon, and thank you for having me. I did remember that first webinar we did in the heat of COVID when I was like trying to stack the right number of books under my laptop, like in the corner of my living room, to make it look a little bit less like we were all just sitting in our pajamas, twiddling our thumbs to pass the time. So it's we've come a long way. Thanks for having me. My name is David Fryman, founder of Fryman PCs, a law firm that focuses on commercial litigation and startup law. I apologize for my voice. I have a cold. This is not normally what I sound like, but I am on the mend and I feel better than I sound. So we are good to go. Usually when we talk about scams, and people getting involved in businesses as either investors or co-founders or other stakeholders, I usually see it from the litigation angle, right? Those clients come to me when the worst case scenario or the almost worst case scenario has either already happened or is, bearing down like a speeding train, and we have to strategize and basically get ready to go to war. And in that capacity, I've seen a lot of permutations and a lot of the different ways that investors, co-founders, vendors, partners have gotten into trouble. And people are aware that scams happen. People are aware that businesses are not perfect, and they're run by people who sometimes don't do the right thing, sometimes manipulate and lie, and that's why people call me, right, on the litigation side. On the transactional side, a lot of clients think to call a lawyer when they have a deal, they've negotiated what they understand to be the key terms of that deal, and they need a lawyer to, quote, paper it or put a contract together that just reflects the terms they've already negotiated, and then take it to closing. And those are the two roles that, in my experience, clients expect lawyers to play. However, there's recently a client came to me. He had the terms. I had represented him in a dispute previously. Client came to me. He had the terms negotiated for a new investment, but it was just rubbing him the wrong way. There were a couple of things, not even red flags, so to speak. We weren't even at the red flags part of the story, but there were a couple of things he didn't understand about the type of investment, about the company, about the way this company would be making money, and a certain narrative that this business owner was telling him. And he said, "Can you help me diligence the deal?" And I'll admit, my first thought was, are we talking about the same thing? I mean, I'm a lawyer. I can make sure all the legalities are taken care of. Let's get on a call. What do you mean? And to make a very long story, just a little bit of a long story, because we have a whole webinar to take up here. He basically wanted help avoiding some of the scams. And I use scams kind of liberally here, but basically, um, making sure that this is one, a good investment, and by good investment, right, there's the business terms. Are you getting the right amount of value for your money? Are you getting the right amount of equity? Are you getting the right amount of other kicker terms, and other kind of creative terms? We're not talking about that. We're talking about whether the story that the business is telling is a reasonable story, whether it can be backed up. When you kick the tires, is this business what it seems to be, right? And there, I got on the phone with Gershon and I said, I can do the legal side of this. I need help on the financial side. Can you come into this deal? And let's see what we can do together to protect this investor. And the thought process here was not to avoid this investment, was just to dot the I's, cross the T's, and figure out a way to make him comfortable. It was a decent amount of money. I mean, I'm intentionally not giving a lot of specific information for confidentiality reasons, but it was a significant amount of money. And this business owner had a specific narrative of the way that this investment was going to turn into profit. And we needed to make the client feel comfortable investing. That was the goal. He's going to invest. He needs to feel comfortable and protected investing. And so then there's the financial side, and I'm going to kick it back to Ken and Gershon, talk about what you look for on the financial side. What were some of your big questions? What documents did we ask for, look at, examine, and then I'll talk more about, given this information, what are some of the ways that we can structure a deal, whether it's an M&A or an angel investment or anything in between, to make sure that you're getting what the seller or the business says you're getting.
Thank you, David. I want to kind of go back to the original question of what is a scam. And when I mentioned to people that we were doing a webinar on this, they're like, how do you define scam? So I didn't look it up in the dictionary, so this is just kind of my definition, but or my impression, how we approach it. But it's kind of what David was just pointing out. The goal isn't necessarily to get the client out of it, to have the client say no. And there are business terms, and you always have those questions. Is this a good business? Right? We have businesses that we've looked at where they were growing top line revenue, but they weren't growing bottom line revenue. So they couldn't figure out how to be profitable. Is investing in a business like that a scam? I don't think so. It's just a bad investment. That's not a smart thing to do. Excuse me. But as you'll hear when we go through the story, or with a little bit more about the investment that we looked at together recently. And again, Ken took a lot of the lead on, Ken did take the lead on this, but some of the things that we found there were just, we felt that they weren't being honest, they were being evasive. We'll get more into it, but we reached the point where sometimes you look at something and you say, like, a Ponzi scheme, it's not just a business that doesn't make money. Not that this was a Ponzi scheme, though I think there's room to argue that it was. Get to that later. But a Ponzi scheme, it's not a legitimate business. It's not what they claim it is. They're not investing in whatever and giving you returns. They're taking returns from other people's investments. So that's a scam. But there are plenty of legitimate businesses out there that don't make money. And it's important to understand that when you're looking at a deal, you want to look for both of those things. As we had a client that asked us recently, Ken and I were on the phone, And the client said, if they gave us this business for free, should we take it? And we didn't say yes. We couldn't say yes because this was a business, was a legitimate business providing a service. They were losing so much money, and it was unclear as to how they were going to turn it around. And there were so many different issues, from financial issues to culture and personnel issues. It was like, this is probably not a really good investment. It wasn't a scam, but it was still something that you want to be really careful before you put your money into. So that's my preamble on scams. Now back to our story. By the way,
Can
Ken,
I just jump in for a second?
yeah, sure.
Just had specifically on that. I think that, a scam makes a good headline, right? And that's why it's in the headline. And but there's obviously a spectrum, and we're going to talk about particular kind of scam, but the types of diligence and the types of legal protections you should employ to avoid getting scammed are also going to be really helpful tools to help you avoid making less than ideal investments. Because there are investments that are perfectly legitimate, they're just not a great use of your time and resources. And the way you can protect yourself from those is similar. It's just the marketing people felt that we might not get as many subscribers if we ran a webinar titled "How to Avoid Less Than Ideal Investments." So it's certainly, obviously, a scam is going to be an extreme version, but a lot of the tools and the techniques, or actually all of them, you should employ, even if there's no chance that it's a scam, and you can establish that relatively easily. You still want to make sure that you are protected from just a business owner that might not mislead you intentionally, but just has wildly overambitious or unrealistic projections about their business and wants to bring you in. You should kind of go through those same processes, questions, etc. So sorry, kick it back to you, but that I think that's when we're talking about the definition of scam, I want to throw that in there.
Okay. Well, so David, thank you for that. And I agree with that 100%, with the caveat that I would like to defend the marketing people. I believe that this deal was a scam. Even if you don't, I think you do too, but even if you
No, I
don't,
do too.
okay. But yes, I endorse everything that David just said. All right, fine. So let's talk about what happened here. So David calls us up and he says, "Hi, I've got this company. The guy wants, diligence. Do you do that?" I'm like, "Sure, we do diligence." I had a call with the client, and the client sent us a bunch of random documents. It was incoherent. So I sent it to Ken and said, "Ken, can you figure this out?" And Ken figured it out. We had a couple of conversations with the client, and I'll walk through kind of what we found. This is a fictitious company, but it'll give you an idea of what we were dealing with. So, meaning we've changed enough details that hopefully you don't figure out what it is. But so we're going to call it an adult daycare chain in Chicago with special city funding for a particular demographic. So the deal that came across really sloppy, right? That was one of the first things that we noticed. Like I said, I couldn't even understand it. Ken spent the time, put it together, and what we came out with was a really good deal, right? We looked at, they had an amazing story for revenue. They had a great gross profit. Gross profit is basically revenue minus direct expenses. So think of the daycare revenue minus the rent, minus payroll, that kind of stuff. They were going to be making a fortune, right? Their overhead was a problem, but they claimed that they were going to grow past overhead, because with the money that we needed, they would with the money that we were providing, they would be able to secure the daycare set, the new buildings, and get new contracts, and all wonderful story. And the overhead was fixed. They were going to grow, and overhead would basically stay the same. It was a great story. But then some things kind of started to get weird. Ken, do you have anything to add at this point? Or
Yeah, the financials, their model looked great. It was asking them, was a best case, worst case, or middle of the road scenario. They agreed that was kind of best case scenario, but that there was still room on top of it. The funny parts were, they laid it out as investment in a viable business, and then they had contracts to service to grow the business, which, that's where we started digging into.
all right,
And that's where the issue started.
right. So on every deal, or in most deals, there's certain critical things, and they're just in every business, in every deal as well. There's certain critical things that you need, and so I mentioned before we had a different deal where it was staffing agency, and they were growing revenue, but as they grew revenue, their gross profit, the revenue minus what they were paying their people, was going down. So basically, as they grew, they were basically making less money, certainly a smaller percentage. Right? Their revenue was beautiful, but they weren't making money. That was the problem. In this business, the story was great, but revenue was critical, because by taking our money of our client, they were going to be able to fulfill a whole bunch of these contracts. And so Ken started going down the road of, what do these contracts look like? And does the story that they're telling us match what the contracts look like? And we very quickly found out that there were no contracts. There were kind of relationships with people who maybe had contracts. And then it turned out that those people didn't have contracts either. And the whole thing became very, very tenuous. How we know that we're going to get any of this revenue, meaning we're going to go get these daycare centers, who says that we're ever going to get the contract to get reimbursed? It was a special type of deal where they were getting paid above market rate for catering to a certain adult population. And our question was just, how does that work? Is it true? And again, as we dug, the relationships were basically non-existent. There was nothing in writing. And when we started asking them for the contracts, they couldn't, not the contracts, for just information on the program. This was a government program. The information they couldn't supply it. They started making up stories. They had NDAs that they suddenly needed to send us publicly available information on a government program. We looked on the government websites, couldn't find anything. Just so you understand the magnitude of this, we were talking about, if I recall correctly, probably doing 30 million in revenue a year off of these contracts. Ken, is that about right?
That's right.
Okay. When we dug, we found, and by the way, when I say we, a lot of this is Ken, most of this is Ken, and Ken is amazing, as is the rest of our team, and David, and all of you. But when we dug, what we found was there was a similar contract, a similar program that the government had created. It was like a $16 million program, and it had essentially either been spent or expired 6 to 12 months prior. So what we had was, we found the government, and we found that they once had a similar program, but there was no program that was going to be providing $30 million a year of revenue. This whole business plan, all the profit that was going to be generated, was built on being part of this program, and the program essentially didn't exist. And so that, coupled with the red flags, every time we talked to them, they needed the money. They needed the money yesterday. Otherwise, it wasn't going to work. It was all going to not work. When we came back to them with some of this, they basically, and they basically changed their model so that in any case, there would always be the same amount of profit. So what they did was, let's say you didn't have this government program, they like made up some other program or found some other program that already existed and said, instead of, let's say the program they were talking about was going to produce 30 million of revenue and 10 million of profit, and you needed 100 members, 100 patients for that. They found some other government program. They're like, well, if that one doesn't work, we'll do this one. And this one will pay us less money per patient, but we'll have 200 patients. Well, why weren't you saying 200 patients before? So they just kept changing the story. And the only thing that stayed consistent was they needed exactly whatever it was, $2 million. They needed it yesterday, and it was always going to equal, 150% return, or whatever the exact metrics were. And I learned this in one of my first jobs. I was working in a large organization. We were running a $3 billion budget, and we were doing cash flow forecasting. And somebody involved in that process basically tweaked the last few months of the year. Whatever happened in January, February, they would always just change November and December so that the final number came out the same. And eventually our CFO looked at this and he's like, guys, whatever happens, we're always going to end up in the exact same place at the end of December. That's outrageous. And then it turned out they had some sloppy Excel model and weren't paying attention. But the point is, these people were doing this. Anything that changed about the details, they always came out with the same story, or close enough. That it was obvious that they needed this. They needed the money. They needed the story to work. It didn't really make a difference, if we had credible questions. Ken, do you have anything you want to add in to what I've just laid out? Additional color?
Yeah, I mean, the initial investment was portrayed as buying a distressed business and then utilizing those government contracts to grow the business. So the investment was to buy the distressed business, turn it around by taking advantage of those contracts, and then things started popping up. All right, give us the historical financials for that business. And they're like, oh, that's not necessary. You don't need that. Let's see the contracts. And they wouldn't supply information. There was a seasoned investment group. They've done over $30 billion in deals. Well, that's what they quote on themselves, doing over 30 billion in deals, but they had no marketing or any kind of presentation put together for the deal, for this investment. And when you asked them questions or made requests, you were given anecdotal responses or stories, news articles about programs, nothing solid from the government or from the agencies that were implementing the programs. So it was just a red flag after red flag, and you just kept digging, and every time you asked a question, they would stall the process by asking for an NDA or wanting to circle back later. They just kept pausing it until they got the urgency where they needed the money and started making demands that this had to close in days. So they just kept adding on to their red flags.
Should I talk about the Ponzi scheme? Oh, go ahead.
I'll just jump in for a second here. I think for me, at least, one of the biggest red flags, and this, in the grand scheme of things, this seems very minor and was not the primary sticking point, but in retrospect, completely fake or exaggerated urgency is a giant red flag. And in the moment, again, it's not like the main reason why you ever walk away from a deal, but it's a big red flag, because if you're doing any kind of reasonable, honest projection and you say, we absolutely need this money by tomorrow, next week, the end of the month, or we're not going to be able to do the thing, one of two things is true. either you are lying to get my money, or you have a bigger problem, which is you've structured your business where you can't keep going unless you get an arbitrary amount of money by this date, and you don't have time to allow your investor to do diligence. Both of those are bad things, right? So if a business is coming to an investor saying, we have this great opportunity for you, it's a healthy business, it's a profitable business, you're going to do great. And also, we are completely out of business and destroyed unless we get some large number of dollars in 2 weeks from now. Something is not there. It's perfectly fine to approach investors and say, here's my runway. Um, Businesses do have a runway, right? There is a point in which, especially in the startup world, this is pretty common. You're not profitable yet. You're waiting on another round of investment. But do it honestly, do it out in the open. Don't go to your investors a month before, because you're just signaling that you're not profitable. That's basically what that means. So yeah, um, I would kind of always be suspicious of a certain kind of urgency, especially when they're large dollar amounts. And if the and one technique that I've recommended to investors, if you are looking at an investment and they say, we need this money within 2 weeks, that's our timeline. The next question is, okay, great, why? Like, just show, meaning, is 2 weeks because you're going to run out of money? Is 2 weeks because you're launching something and you need capital for it? Is it because you can't make payroll without, like, it's reasonable to have an emergency. Businesses have emergencies. I'm not, saying that just because you have a cash crunch that you are a scam or a poorly run business. Definitely not true. But if what you're doing is honest, then the response to I need this money now should be, okay, great, just show me why, connect the dots for me so that I can feel comfortable that you are who you say you are.
And in this case, by the way, David, they had their basic story was they needed to, again, without getting too detailed, there was a contract imposed date which had kind of passed by the time we even started with this. They were like, the program started 2 weeks ago, and basically someone else will get access to these patients or these members. If we don't take advantage of this contract today, they actually had someone involved in the business who allegedly was a criminal and couldn't be involved in government contracts. And the people putting this deal together, who, as Ken pointed out, claimed to have had billions of dollars, $1 billion deals done, they were basically saying they were almost like brokering. They're putting this deal together where they needed a new face for the business so that they would have access to these government contracts, and that government contracts, otherwise someone else would get them. Again, as it turned out, there were no government contracts. We have a question here from Neil. What was the time frame from the inception of the deal until you realized this was an issue, and for how long that continued before pulling the plug? So we have a lot of Jewish people on this call. I'm pretty sure this happened between, like, right before Sukkot. I would say between Rosh Hashanah and Sukkot is when this started. The arbitrary date when it all had to be done was basically beginning of September. So the date had already passed. And then I would say by late October, we realized that this wasn't going anywhere after numerous rounds. And again, they always needed the money by yesterday. But again, the biggest issue was that they couldn't substantiate the revenue, right? This was a revenue-driven deal. This business was going to happen because of this revenue, and there's no evidence that the revenue potential really existed at all. All right, so I think I'm gonna give our theory as to my theory anyway. See if Ken and David agree as to why this really was a scam, almost like a Ponzi scheme. Besides for everything we've said so far, I think this is Ponzi scheme-ish. And then I'll let David and Ken either respond, or David go on to like more about how you protect, and then I think we're going to wind down soon. This client of ours had loaned money to this syndicate before. And the theory, I think this is the client's theory by the end, actually, was that, well, it resonates. The money was loaned and it was backed by real estate. Client's theory is that these people wanted to pull this in with this scam investment and then take the money from their left pocket, put it in their right pocket, pay back his secured loan. And then now he just invested in this business. Sorry, didn't work out. Couldn't get the contracts. We burnt the money. Better luck next time. And basically move this from being a secured deal where they had property on the line to something which could just evaporate. To me, that's close enough to Ponzi scheme because it's not one investor to another, but it's one deal to another. And I don't know, I think it's Ponzi scheme-ish. But anyway, Ken or David, if you have anything to add, otherwise David, continue. Please.
I think that's we talked about this, and I think that's a reasonable theory, and I also think agree that the client kind of suspected that towards the end. I will caution something, and I'm not saying, Gershon, that you were going there, but I think there's a tendency when dealing with prospective deals to focus on the intention and good faith of your counterparty, which is important, but ultimately often doesn't matter, right? Because at the end of the day, somebody can be shady and give you a decent return, and somebody can have the best of intentions. But if they're incompetent, unprepared, have wildly unjustified projections, when pressed against the wall and confronted with a business that is on the verge of falling off a cliff, even somebody who started with a legitimate business, often, and again, this is just less about business or law and more about human psychology, will often cover it up, tell white lies that become bigger white lies that have to snowball. And if all you're asking along the way is this a good person? Do they mean well? Are they really trying to launch or run a legitimate business? You're missing a big part of it. I'm not saying, I think also, it's not either or. Also, you should try to do business with decent people, because I think that all the contracts in the world will protect you so much. But at the end of the day, do business with decent people, and also do business with competent people, because somebody that has the best of intentions, if somebody's using a lot of hand-wavy numbers to try to justify a projection or a valuation that is, and you want to bend over backwards, kind of give them the benefit of the doubt, that's often going to come back to bite you. And I think that one thing about this deal in particular that I want to emphasize that goes to valuations, when your valuation is based on kind of informal commitments, informal commitments are not contracts, and contracts are not revenue, right? There's a default rate on each of those stages. So if somebody has, $1 million, let's say, just to throw out an easy number to keep the math easy, $1 million of kind of informal commitments right? That might turn into 750,000 of contracts, which might turn into $500,000 in revenue, right? And if you're wrong about that projection, you're just going to end up in a situation where, hey, I thought you had $1 million of revenue here. Well, look, you have to understand, I had this deal lined up, they promised, and let's just assume, for the sake of argument, that they're honest here. You still need to focus on, okay, well, when you say there's $1 million, is that a commitment, or is that a contract, or is that cash already coming in? Either of those answers is fine, as long as everything is transparent, and so you can adjust around that. And that leads me into the point about how to avoid these kinds of situations. Something that is if a feature of every M&A deal, every investment, the vast majority of business contracts are reps and warranties, representations and warranties. And the legal drafting nerds among us can quibble over whether you actually need to say both of those things. We're just going to sidetrack that. That's another webinar for a nerdier topic. But basically, way too many M&A deals and investment documents have boilerplate reps and warranties. You know, it'll say the parties have the authority to enter into this contract. And all of the entities listed in section 7.3 are duly formed, right? Okay, fantastic. You've confirmed that your Delaware C Corp and your Nevada LLC are in fact what the companies they purport to be, right? And then you might see an appendix of some financials and say, we represent, to the best of our knowledge, these are accurate, but we can't guarantee, right? And what I think, and in this particular case, had we gone forward, because the client ended up walking away for a good reason, and he was right. But in the background, I was preparing to go forward with the deal. And one of the ways that we were going to protect him is by extensive, specific, and personally guaranteed representations and warranties. That is a buyer's best protection ultimately against a scam on the legal side if you're going to go through with the investment. Anytime you do a large-scale business investment of any sort, there are certain things that you think make this a good deal, right? That's just, and very often you'll even see on the other extreme a contractual provision that says the buyer is not, or the investor is not relying on anything other than what's stated explicitly in the contract. And that's to kind of create a limited universe of recourse for the investor or the buyer or other stakeholder, right? And those reps and warranties, use them. There is a reason you think this is a good deal. Not all of the facts matter to you. You looked at this deal for whatever reason, you think it's a good deal. You've decided that there's some risks, notwithstanding the risks, because of these three things, right? I'm still going to go forward with this deal. Fantastic, wonderful. Put it explicitly as a representation and force the sellers or the promoters of the deal to personally guarantee that. Now, that sounds scary. How they get? I'm not saying they're personally guaranteeing your money. If you can get that, that's also great. But if somebody is representing information to you, they should be able to say personally that this information that I'm giving to you, that I took from my books and records, is true. And that's why you're investing in this deal, is wildly important. because ultimately that's that's how you can make sure that if this is the reason you're investing, then it's true. Another important protection is control. If you are investing, let's say, as a whether it's as an angel investor or coming in as a co-founder or any kind of minority investment, right? You are essentially out of control. You are a minority, you have no ability, you might have a vote, but it's not going to mean much if your counterparty still owns a majority of the company. So one thing you can do is, again, if you have specific concerns, is negotiate for veto power over certain types of decisions, right? So if, for example, you are funding a certain kind of expansion in a company, you are funding your funding allows the company to go into a new market, give yourself control, give yourself realistic voting power in that new context, in that new venture, so that you can protect your asset. And if something is fishy, you're in a position to do something about it if you actually have concrete control. I would say those are the two biggest points. One more that I'll just throw in there is understand what the investment documents give you in terms of the duties you are owed. For example, on one end, if you are an angel investor investing on a safe note, those are designed to be pro-founder, not pro-investor, and you are not entitled to fiduciary duties. You have recourse in the case of fraud, an extremely high standard, but other than that, negligence, gross incompetence, completely taking your money and flushing it down the toilet, unless it's specifically fraudulent, you have very limited recourse. And again, if that's what you negotiated, that's what you negotiated, but there's often room to customize these documents, right? A lot of businesses, they'll send you form contracts to invest. It's your money. If you're investing, negotiate. Make sure you are comfortable with the terms. And you can, right, there's no, you either are fiduciary or you're not. Sort of true, but you can customize exactly how that plays out. And if you are bringing value to the company, especially if they're telling you, we need this money by the end of whenever to make it work, well then, work with me. Give me voting rights, right? Personally guarantee certain representations about the company, etc. So that's kind of a big picture framework that I would say on the legal side, as someone who has litigated all of those issues. And I see it all the time. I think that it would be great to see clients come to me before they have to litigate. It happens. Litigation is kind of a fact of business. That's why I have a job. But there's a lot that lawyers and CFOs can do in advance to prevent a bad investment or soften the blow. Because even if you go through with the investment, and even if the investment turns out to be problematic in some way, your diligence might have allowed you or shown you where to focus your negotiation power, your leverage, to get the right types of reps and warranties to give you more recourse when the excrement hits the fan, so to speak.
Thank you. Thank you, David. One thing I want to add, something David said a few minutes ago, which is that I should take this line for myself, but what was it? Handshakes are not contracts and contracts are not revenue. When you have, and this is more of a financial topic, not a scam topic, but when you have a single point of failure, when you have one thing which can blow everything up, that one thing obviously becomes much more significant. So if you have 10 contracts for $1 million, that's not the same as one contract for $10 million, right? David's math probably works better with 10 contracts for $1 million. A few of them will work, maybe most of them will work. And the ones that do get signed, 2/3 or whatever will actually happen. And that's where, you have handshakes that turn into revenue. With the deal like what we were looking at here, most of the revenue and all the profitable revenue really was coming from one thing. And so if there were any issues with that one thing, the whole business basically didn't exist. Okay. So I'm going to take a minute and just tell people about our deal forwarding service, which we actually started this month, beginning of January, and then we'll jump into Q&A and wind down. Deal forwarding service basically is, we've had investors who show up at our doorstep and they say, hey, we're looking to buy ABC. What we used to do is we would say, well, do you have ABC? And if they said no, we would say, okay, here's a bunch of business brokers. Why don't you go reach out to them? Sometimes they did, sometimes they didn't. And what we came up with was the deal forwarding service, where we basically will monitor the business brokers on behalf of our clients. And for a low monthly fee, we'll stay in front of those business brokers so that you don't have to. We did a beta this month. We had our first client. They were looking for 2 different businesses. They changed in the middle of the month, but whatever. So we've looked for 3 different types for them. But, we got in front of numerous brokers. We've got monitoring 5 different business broker sites, 6 brokers, I think, actively looking. We've spoken to numerous business brokers. And over the month, we ended up finding him 3 companies that fit his specs, 3 more companies that were close, and 2 that were exact matches, kind of exact matches. But then he changed his mind, his priorities. So we found 2, and then he said, oh, no, I really want something else. Then we found 3, something similar to 3 of those others. Anyway, anyone who's interested, you're welcome to reach out. Oh, and the offer was, if you reach out before Valentine's Day, then it's half price for the first month. So reach out. All right. What else? So we have a questionnaire we're going to put up, and then we're going to do Q&A. So David, thank you very much for all of your amazing insights. Thank you to all of our guests. And we have a question in the chat, and then we will jump into any other questions that anyone has. Question in the chat is from Saul. How did the parties know each other? Did they sit in shul next to each other? That's synagogue. So church, country club, use your preferred social scene. Were they recommended by another victim? Was it a friend of a friend? So what I can say is that this fellow had done other deals and been paid back, which fits very well into the whole Ponzi scheme idea. I don't know how he originally met. David or Ken, did either of you uncover how they originally met before the first deal?
No, they did prior deals together, but at a much smaller amounts.
Yeah, that was my impression also. They did a prior deal together, much smaller amount, and it wasn't it was it was a loan. It was not a
Investment.
equity investment.
Right, and it was a real estate backed loan.
Yeah.
So it was very safe.
Whole different animal, yeah.
So that's that. All right, questions. And then let's put up the question. Brittany, can you put up the questionnaire, please? There we go. Thank you. Um, anyone have any questions, comments, thoughts?
No, it's a great poll.
It's a great poll.
Cool feature.
Thank you. So the poll helps us figure out what to talk about and make intros if you would like. Um, all right.
This might be a stupid question. The questions you're reading, where are they coming through?
You don't see the questions?
No.
That's there. There's a questionnaire that popped up on the screen.
No, the questionnaire popped up, but you were reading questions from the chat.
Oh, people private messaged me
Oh,
while
got
we
it.
were talking.
Okay.
So the first question was about the time frame. The next one was about the affinity fraud, which definitely is a real thing out there.
Yeah.
So be careful.
So if there aren't other specific questions, I just want to kind of close with a point that we've made, but it bears emphasis. I'm a lawyer. Ken and Gershon are financial CFOs, right? And you tend to think of us as you know, on the CFO side, as going into businesses and maximizing your financial strategies, coming up with financial strategies to grow and avoiding financial pitfalls. You tend to think of the lawyer as either papering a deal on the one side or having to litigate and send nasty letters. And while it is true, we do those things, right? I would urge you, if you are considering a um, a business investment, whether you're investing as an angel, whether you're investing as an LP in a larger syndicate, whether you are investing as a co-founder or other stakeholder, take a step back and utilize your team, whether it's your legal team, your financial team, and this is something that Ken, Gershon, and I are adding to our toolbox because there is a need, and I was kind of aside from the interesting way that this came about, this particular deal came about, we saved potentially seven figures for this client that was about to walk into a disaster. And even if you're not thinking about an investment or a business deal of that size, if you are contemplating something and even if you don't see any red flags or you feel reasonably confident, there's no way that unless you are particularly trained, you are not going to be able to go through that balance sheet as well as Ken and Gershon, and they have a lot to offer on diligence to help you do that. It can save you massive headaches later on, and on the legal side, whether you come to my firm or any lawyer, do not go to your lawyer and insist that they paper the deal you already negotiated and leave it at that. You are wasting an opportunity to have your lawyer protect you by customizing the deal documents in a way that reflects why you're investing and the best way to make that happen.
Thank you, David. Thank you for the endorsement. I agree with all that. Anyone who hasn't answered the poll, please, if you can take 10 seconds, fill it out. That would be helpful. We would appreciate it. Yeah, and thank you, David, for joining us and helping us put on a wonderful show. I had
My
a
pleasure.
good
Thanks
time.
for having
I
me.
hope you did too. Very insightful. And thank you, Ken.
No
We
problem.
finally got you to do a webinar. You did a great job. Thank you for joining and participating. All right. Thank you, Brittany, for setting this up. Thank you, everyone who joined, who's still here. And talk to you all soon.
Thanks, guys.
Bye,
Bye-bye.
David.